I want you to picture two scenes. The first scene is 1929. A bank in Chicago has announced it is having difficulty meeting withdrawals. By morning, word has spread through the neighborhood. People come to the branch, they stand in line. The line grows longer. Hours pass. The bank tries to demonstrate liquidity, counting cash visibly through the window, reassuring depositors in person. Some leave, others stay. By the end of the day, the bank has been strained but survives. The slow speed of communication gave it time. The second scene is March 9th, 2023. Silicon Valley Bank's management has announced a capital raise the previous evening, intended to signal strength. The announcement is immediately interpreted as distress. By 7 in the morning, venture capitalists on the West Coast are sending messages through group chats, signal threads, and direct emails to the founders of their portfolio companies. The message is simple: get your money out now. By 10 in the morning, billions of dollars are moving. By close of business, customers have attempted to withdraw $42 billion at a rate of more than $1 million every second. By Friday morning, the 16th largest bank in the United States no longer existed, 44 hours from functional institution to federal seizure. The difference between those two scenes is not the underlying banking weakness. Both 1929 and 2023 involved banks with real problems: asset quality, duration mismatches, leverage. The difference is the velocity at which confidence collapsed. And confidence in the modern banking system is the only asset that actually matters. This is Capital Briefing. If you are here for the first time, hit the subscribe now before we go further. Turn on notifications. What we build on this channel is the translation of structural shifts in the financial system that most people do not see until they are already living in the consequences. Subscribe now. Then let me explain why the next banking crisis will not look like anything the system was designed to handle. Let me start with what modern banking actually is, because the textbook version and the operational reality have diverged in ways that matter enormously for what comes next. The textbook version of banking is simple. Banks take deposits from savers and lend them to borrowers. They maintain enough liquid assets to meet normal withdrawal demands. They are backstopped by deposit insurance up to certain limits. They are stress tested by regulators. They have access to emergency lending from the Federal Reserve. The system is designed to be resilient. All of that is technically true. None of it accounts for velocity. Modern banking is not a balance sheet operation. Modern banking is a confidence operation. What backs a dollar deposit is not a dollar in the vault. It is the depositor's confidence that they could, if they needed to, receive a dollar. That confidence, and only that confidence, is what makes the system function. The moment a sufficient number of depositors simultaneously decide they need to test that confidence, the system faces a problem that no stress test has ever been designed to simulate at current digital speeds. Here is the mechanical problem in precise terms. A bank that holds $100 in deposits needs only a fraction of that in liquid assets to meet normal daily withdrawal demands. In normal conditions, only a small percentage of depositors withdraw on any given day, and new deposits continuously replace outflows. The bank is structurally solvent as long as the aggregate behavior of depositors remains distributed, as long as not everyone withdraws at once. The entire system is predicated on depositors not coordinating. Digital communication, group chats, social media, messaging platforms, algorithmically curated news feeds, is at its mechanical core a coordination technology, and it is now operating at a scale and speed that fundamentally changes the withdrawal physics of a banking panic. Subscribe to Capital Briefing if this framing is delivering the structural clarity you have been looking for. Turn on notifications. The next video on this channel examines the specific regulatory gaps that the speed of modern bank runs has exposed, and what the Federal Reserve's emergency toolkit actually looks like in a scenario where the run happens faster than any intervention can be authorized and executed. Subscribe now. Then let me take you inside what actually happened in March 2023, because the SVB collapse is not primarily a story about a bad bank. It is a story about what digital bank runs look like, and it is the only complete working example of one that we have. Silicon Valley Bank was not, in the conventional sense, a terrible bank. It was certainly poorly managed, its duration mismatch, its concentration in a single industry, its inadequate hedging. These were real failures. But on March 8, 2023, the California Department of Financial Protection and Innovation stated publicly that SVB was in sound financial condition. What happened in the next 44 hours was not fundamentally about the bank's balance sheet. It was about the architecture of trust in a digitally connected ecosystem. Peter Thiel's Founders Fund withdrew all of its deposits on the morning of March 9th. That decision, made by a single firm, was immediately visible to a community of venture capitalists who were deeply networked with each other through shared group chats, Twitter, LinkedIn, and direct contact. Prominent investors began publicly advising their portfolio companies to withdraw. Those advisories circulated instantly through the same channels. Founders of hundreds of startups, all holding large uninsured deposits, all in the same digital communication ecosystem, received the same signal at approximately the same time. The result was the fastest bank run in recorded financial history. $42 billion withdrawn in a single day. More than $1 million every single second of the trading day. To put that in context, Washington Mutual's failure in 2008, which was at the time the largest bank failure in U.S. history, involved $16.7 billion in withdrawals over 10 days. SVB lost 2.5 times that amount in one day. The difference was not the severity of the underlying problem. The difference was the coordination infrastructure. What Capgemini's Chief Technology and Innovation Officer described after the collapse is the precise mechanical statement of what happened. Once concerns circulated among interconnected depositors, billions in withdrawal requests arrived within hours, outpacing any manual intervention or escalation process the bank had in place. Any manual intervention or escalation process. That phrase is the key to understanding everything that follows. The regulatory response to a bank showing signs of distress involves a sequence of decisions. Executive conversations, board deliberations, regulatory notifications, emergency credit facility applications, public communications. This sequence was designed for a world where a bank run develops over days, giving each step time to be completed before the situation becomes irretrievable. In the SVB collapse, that entire sequence was irrelevant. By the time any intervention could have been authorized and executed, the institution had already failed. The velocity of the collapse exceeded the velocity of any available response mechanism. That is the structural problem, and it is not fixed. Now let me explain why this matters right now, in 2026, and not just as a cautionary tale about 2023, because the conditions that made SVB vulnerable in 2023 are not unique to SVB. They are systemic features of the U.S. banking landscape, and several of them have not improved since the collapse. The first condition is uninsured deposit concentration. The FDIC insures deposits up to $250,000 per account per institution. For individual retail depositors, this is generally adequate. For businesses, for startups, for institutional depositors with operational cash requirements, it is not. Many businesses routinely hold multiples of the FDIC limit in a single institution. SVB's particular vulnerability was extreme. At the time of its collapse, an estimated 86.4% of its deposits were uninsured. That is an unusually high concentration, but uninsured deposit risk is not unique to SVB. A stress test developed by a finance professor at Florida Atlantic University, the Uninsured Deposits to Liquid Assets Screener, measures how long a bank can survive a 2-day run by uninsured depositors. Applying this test to 158 U.S. banks with over $10 billion in assets, Two banks have ratios above 300%, meaning their uninsured deposits exceed their liquid assets by more than 3 times. 13 banks are above 200%, 37 are above 150%, 94 are above 100%. These are not small community banks that no one has heard of. These are significant institutions whose balance sheets carry structural vulnerabilities that would become acute in the event of a digital bank run. The second condition is commercial real estate exposure. $875 billion in commercial real estate debt is maturing in 2026, according to the Mortgage Bankers Association. These are loans that were originated during the era of near-zero interest rates and must now be refinanced at rates that are meaningfully higher. Commercial real estate, particularly office properties, has been under structural pressure since the pandemic-driven shift to remote work. Vacancy rates in major urban office markets remain elevated. Property values have declined. The combination of higher refinancing rates and lower property values means that a significant portion of this maturing debt cannot be refinanced on reasonable terms. The institutions holding this debt are disproportionately regional and community banks. The large money center banks, JP Morgan, Bank of America, Citigroup, have regulatory requirements that limit their CRE concentration. Regional banks do not face the same constraints, and many of them concentrated heavily in CRE lending during the low-rate years. The Office of Financial Research has stated directly, CRE loans could generate significant future losses that exceed shareholders' equity for certain banks, particularly those that also carry unrealized securities losses and a high share of uninsured deposits. That combination, CRE losses, unrealized securities losses, and high uninsured deposit concentration, is precisely the combination that destroyed SVB. And it exists today at multiple institutions across the regional banking system. The third condition is the amplification architecture. Social media has not become less influential since 2023. It has become more influential. Algorithmic feeds have become better at identifying and amplifying signals of financial distress. The networked relationships among institutional depositors, venture capitalists, startup founders, family offices, corporate treasury departments have become more interconnected, not less. The next institution that shows a credible sign of weakness will face a withdrawal environment that is not better than SVB's. It will be worse, because the amplification architecture is more mature, more efficient, and more capable of coordinating mass action faster than it was in March 2023. This is the structural reality that regulators have not fully addressed. Now let me describe what the next digital bank run might look like, not to predict a specific institution or timeline, but to make the mechanism concrete and comprehensible. The sequence begins not with insolvency, but with perception. An institution carries a meaningful CRE loan book. Several of its largest loans go on non-accrual status in the same quarter. The institution discloses this in its quarterly earnings report. The disclosure is accurate and technically unremarkable. Non-accrual loans are a normal feature of banking. In normal times, the market absorbs the disclosure with a modest stock decline, and the analysis moves on. But this institution also has a significant uninsured deposit concentration, corporate treasury accounts, institutional depositors with balances well above the FDIC limit, and its earnings report circulates through financial media, through social platforms, through the same group chat infrastructure that distributed the SVB warning in 2023. Within hours, a prominent financial commentator on social media posts an analysis noting the combination of CRE non-accruals, unrealized securities losses, and uninsured deposit concentration. The post receives significant engagement. It circulates in the same digital channels that depositors use. Large uninsured depositors, those with the most to lose if the bank fails, face the classic prisoner's dilemma. If they stay and others leave, they are the last ones out. If they leave and others stay, they have cost nothing by being cautious. The rational response for any individual large depositor, once the signal has circulated, is to act on it. The institution's online banking platform begins registering unusual withdrawal volumes. Not catastrophic initially, but unusual. Enough that internal monitoring systems flag the activity. The institution's management begins an emergency process, calls with regulators, assessment of available credit facilities, preparation of a public statement, but the withdrawal velocity is accelerating, not because of new information, because of the withdrawal velocity itself. The fact that others are leaving becomes the information. By the time any statement is drafted, reviewed, approved, and released, the bank's liquid asset position has deteriorated meaningfully. The statement, whatever it says, is now operating in an environment where the facts on the ground are changing faster than any statement can keep up. This is the modern bank-run sequence. It does not require fraud. It does not require egregious mismanagement. It requires only a credible trigger in a highly connected environment with enough uninsured depositors to generate a withdrawal velocity that exceeds the institution's liquidity management capacity. The system was not designed for this. The emergency toolkit was not designed for this. The Federal Reserve's Bank Term Funding Program, launched in March 2023 in the immediate aftermath of SVB, was designed to provide emergency liquidity to banks facing deposit outflows. It allowed banks to pledge eligible assets at par value to access credit. It was a meaningful intervention, but even the BTFP, which has since expired, operated on a timeline measured in days. Applications, collateral posting, credit approval, these are processes that take time. Time that a digitally driven bank run may not provide. Let me now explain the deeper structural issue, the one that makes the speed problem more than just a logistics challenge. Modern banking confidence is not distributed, it is networked. In 1929, depositors were largely independent of each other. Your bank-run decision was based on what you saw and heard in your immediate physical environment. The bank run propagated through physical proximity and word of mouth. It was fast by the standards of the era, but it was bounded by geography and communication infrastructure. In 2023 and beyond, depositors are networked. The decision of one significant actor, a venture fund, a prominent investor, a large corporate treasury, is immediately visible to every other actor in the same network. And the networks that connect institutional depositors are highly efficient, highly trusted, and increasingly algorithmically amplified. This means that the propagation of a bank-run signal does not follow the physics of word of mouth. It follows the physics of network diffusion, which is categorically faster. The SVB run did not spread slowly through a neighborhood. It spread instantaneously through a network of several thousand people making consequential financial decisions in real time. The regulatory and supervisory infrastructure was not built for network diffusion. It was built for word of mouth. And that gap, the gap between the speed of the crisis mechanism and the speed of the response mechanism, is the fundamental structural vulnerability of the modern banking system. This is the thing that almost nobody in mainstream financial commentary is saying clearly, because it is uncomfortable. Because it implies that the problem is not fully fixable without fundamental changes to how banking and digital communication interact. Because acknowledging it creates a tension between the regulatory imperative to maintain confidence and the analytical imperative to describe reality accurately. I'm going to describe it accurately. Now let me talk about what the practical implications are for anyone watching this right now, because understanding a structural risk without knowing what to do with that understanding is not intelligence, it is anxiety. The first implication is understanding what deposit insurance actually covers. The FDIC insures deposits up to $250,000 per account ownership category per institution. For most individual retail depositors, this is adequate protection in almost any banking failure scenario. If your deposits at any single institution total less than $250,000, the FDIC backstop is robust. If you or your business holds deposits significantly above that threshold at a single institution, that exposure is uninsured. In a digital bank-run scenario of the kind that destroyed SVB, Being an uninsured depositor means being in the prisoner's dilemma. The rational strategy for any uninsured depositor who has received credible distress signals is to act on those signals immediately, because waiting exposes them to the risk of being last in line. The second implication is the value of banking relationship diversification. One of the clearest operational lessons from the SVB collapse, confirmed by institutions that went through it directly, is that businesses relying on a single banking relationship had no fallback when access to their operational cash was temporarily interrupted. Payroll accounts, payment platforms, vendor integrations, all of these became inaccessible in the critical window after the failure. The analogy to cloud infrastructure concentration is exact. Organizations that maintained relationships with multiple banking institutions had redundancy when they needed it. Those that did not discovered the gap under maximum stress. The third implication is understanding what commercial real estate exposure means for the institutions you bank with. The publicly available stress tests from Florida Atlantic University and the data disclosed in quarterly bank filings allow anyone to assess the CRE concentration, unrealized securities losses, and uninsured deposit ratios of the institutions where they hold deposits. This is not proprietary information. It is public data that most people do not know exists or do not think to look for. The fourth and perhaps most important implication is understanding the role of speed in any future scenario. The SVB depositors who acted on the morning of March 9th recovered all of their funds because the FDIC and Treasury made all depositors whole, insured and uninsured. The depositors who waited, who reasoned that the situation would stabilize, who trusted the CEO's assurances that it was business as usual, faced hours of uncertainty about whether they would ever see their money again. In a digital bank run, the people who move first move on incomplete information. But incomplete information processed quickly is structurally superior to complete information processed too slowly. That is not how most people think about financial decision-making. Most people think that waiting for certainty is prudent. In a banking crisis that moves at digital speed, waiting for certainty means waiting too long. I want to close with the most important structural point because it is the one that connects this analysis to the broader financial environment we have been describing across multiple videos. The banking system's vulnerability to digital bank runs is not a standalone risk. It is a risk that interacts with all of the other structural pressures that exist in the current environment. Commercial real estate stress, as I have described. Unrealized securities losses that remain on regional bank balance sheets, the fiscal trajectory of the U.S. government and its implications for interest rate stability, the geopolitical environment that creates commodity and energy price volatility affecting CRE cash flows, the concentration of uninsured deposits in institutions that serve networked, highly connected depositor communities. These pressures are not independent. They share common factors: interest rates, credit quality, liquidity, that can deteriorate simultaneously under stress conditions. And the mechanism that would transmit a deterioration in any of these factors into a banking crisis is now operating at digital speed. The system was built for slow-moving crises. The crises are no longer slow-moving. In 1929, lines formed outside bank branches. People could see each other. The physical reality of the line was the signal. Banks had time to demonstrate stability, to count cash, to reassure depositors in person. The next bank run will not happen outside the branch. It will happen on smartphones, in group chats, in algorithmically amplified social feeds, in the same digital infrastructure that connected the SVB depositor community and produced $42 billion in withdrawals in a single day. The speed of that withdrawal exceeded the speed of every response mechanism available to the institution, to its regulators, and to its government. Nothing structural has changed that would make the next one slower. Subscribe to Capital Briefing now if this video changed how you think about the structural vulnerability of the modern banking system. Turn on notifications. Leave one comment. Where do you hold deposits today? And have you ever thought about the concentration of your uninsured exposure? Because the people who thought about it before March 9th, 2023 had options. The people who thought about it after did not.